Welcome to the Capital News. I am your host, Alex Karitis. Today is April 12th, 2019. Thank you so much for joining me. I hope everyone is doing well out there. So let's get straight into some of the market news today. The S&P was up 19 points. The Dow closed up 269 points for the day. That represents a 1% increase. The Nasdaq was up 37 points. And the Russell 2000, the small cap index, closed up 6 points for the day. So again, be aware of these 1% moves to the upside or to the downside, and that's exactly what we saw today in regards to the Dow. Oil is still slightly below $64 a barrel, sitting at $63.76. Gold is still below our $1,300 an ounce benchmark and now sits at $1,293. Silver is also below $15 and settled at $14.93. The 10-year Treasury continues its ascent. It gained 2.25 percentage points today and now sits at 2.56%. The VIX decreased 7.75 percentage point today and now sits at $12.01. So quite the moves in the market today. Now, we spoke yesterday that this was the kickoff to earnings season, and we were specifically noting J.P. Morgan, Wells Fargo, and PNC Financial Services. Well, in regards to PNC, they came in lines with estimates. However, the stock rallied 3 percentage points today. Wells Fargo closed down 2.6% today. This is on the back of them beating expectations. However, future projections were forecasted to the downside. And this came from the mouth of the CFO of Wells Fargo. Net interest income is expected to decline 2 to 5% for 2019. So obviously the market did not like that. They probably liked the fact that on the first quarter they beat expectations, but future forward guidance was to the downside. And so the stock sold off again, down 2.6%. JP Morgan, on the other hand, rallied. Its share price closed up 4.69% for the day on the back of record profits. So we have J.P. Morgan shares surge after bank posts record profit and revenue. The bank's first quarter profit and revenue exceeded analyst expectations on higher interest rates, and obviously the share price surged. Profits rose 5% to $9.18 billion, and revenue also rose 5% to $29.9 billion. Here is a quote from the CEO, Jamie Dimon. Even amid some global geopolitical uncertainty, the U.S. economy continues to grow. Employment and wages are going up, inflation is moderate, financial markets are healthy, and consumer and business confidence remains strong. Well, Mr. Dimon, it looks like you are jockeying for a position within Trump's White House because you're saying everything is peachy and rosy. The data, folks, that we discuss here at length every single day points to the other direction. We can only swim around in this sea of liquidity and funny money for so long. The day of reckoning is coming. This is to prepare you, not to frighten you. Do not be greedy in these markets. If you have been somebody who has made some profits over the past 10 years in this quite remarkable bull market, again, don't be greedy. Maybe take some profits, put some cash away for a rainy day, save it up, do something a little bit more conservative with it, because I just think the risk reward from this standpoint going forward for the next year or so is just not worth it, in my opinion. You let that money work for you over the past 10 years. Again, not because any of us are geniuses here, but because we had central banks the world over printing funny money, and that money was directed into financial assets, stocks, bonds, ETFs, mutual funds, everything. Currencies, went into currencies, the whole currency war goes into real estate, everything. So we honestly here at the Capital News think the day of reckoning is on the horizon. Again, I'm not projecting this is going to be tomorrow. We have our indicators that we look at. We have our leading indicators as far as unemployment is concerned, as far as the yield curve is concerned, and a handful of other things that we look at, excuse me, and we talk about here at length on this podcast. So just be aware of these things. Don't let some fancy central bankers or fancy bankers get out there and tell you that everything's fine when we have a whole bunch of data that says it isn't. Okay, so just be aware of all this stuff. Now, the other thing I want to mention here real quickly is regards to the banking system. I mean, these guys are making record profits towards the end of a business cycle. This does not seem to me like draining the swamp. Again, this podcast does not demonize profit making. In fact, we are very much proponents of free market capitalism, as many of you have been listening know. However, when it's on the back of funny money, when it's because of corporate cronyism joined at the hip with our government, I have a big problem with this. So there is no ifs, ands, or buts about it that when it comes to the financial institutions, especially an institution the size and scope of J.P. Morgan Chase and Company, that's the case. So I do demonize them quite a bit because we were supposed to be draining the swamp. We talked about last year the banks making record profits. Well, that trend is continuing here, at least in regards to J.P. Morgan. All right? So does that seem like draining of the swamp to you? You have to remember it was only 10 years ago, guys, that these guys got bailed out. Hundreds of billions of dollars in U.S. taxpayer money. Trillions with a T dollars in bailouts from central banks all around the world. Not just our central bank, but money that flowed. We bailed out other central banks bailed out our financial institution, and that game is still being played back and forth. We talk about that all the time. You can go look at the data. It's on there. It's on the Federal Reserve's website itself. Go look at FRED, Federal Reserve Economic Data. Go look it up. It's there. You can look at the balance sheet. You can look at the money printing. You can look at the monetary base. Okay, and you can find these things not only for the United States and in the Federal Reserve, but you can see this for the ECB and the Bank of Japan and others. Okay, it's just up, and away. They're bailing each other out. So the banks are getting bailed out. They continue to get bailed out. They seemingly cannot lose because on the one hand, you have the funny money, which elevates their stock prices, and we've had that discussion here many times. But now, in the era of somewhat increasing interest rates, the banks get to make more money because they get to charge higher interest. So the banks can't lose. So you see who you're really working for here. You see why this is a problem. You see why the swamp has yet to be drained, and it doesn't appear that it is going to be drained anytime soon here because these banks are on record profits. Okay? They got bailed out. You did not. Okay? So I don't stand for this. I don't applaud this at all. Okay? At the same time, you have Jamie Dimon, the CEO of J.P. Morgan, coming out and saying everything's fantastic. Again, is he jockeying for a position within the Trump White House? Is Larry Kudlow not able to hack it anymore? Does he need another voice of reason, quote-unquote reason out there to come out there and be a propaganda piece to say everything's fine and rosy? Because it isn't. It isn't. But be prepared. So those are the things that we have to pay attention to. But that was the kickoff to Q1 earnings season. Now, it wasn't just this that led to the rise in the Dow Jones gaining 1 percentage points for today. Now, obviously, J.P. Morgan is a part of the Dow 30, but so is Boeing, and this is a stock, again, we've had this conversation numerous times, specifically since those two plane crashes and then where there's a lot more attention on those planes, the 737 MAX 8 jet airliners that are produced by Boeing, and all of the news that's been surrounding that as some information from those investigations leak out from time to time. So Boeing was up to the upside again, so that had a positive effect on the Dow. Also, Disney is a component of the Dow 30, and they just announced their streaming service, basically that they will be competing with the likes of Netflix at a lower cost point, and quite honestly, given the library and the content of Disney, I mean, it might even be better. So we'll see how well Disney can perform. They have a huge global audience. I'm sure this will prove to be quite successful. And I think the market seems to be on that same wavelength, which is why that stock rallied quite a bit today. So if you're a Disney shareholder, kudos to you. You did quite well today, and probably will for the foreseeable future, unless something adversely happens with subscriptions or something to this service. But even if the subscription service does not work, the streaming service doesn't play out well, I mean, Disney has great content and a great name to go by. So something for the long term, definitely be something that you should consider. So with all of those, that's why you got such a big boost in the Dow, 1 percentage point. But when you look at the S&P, the NASDAQ, and the Russell, there wasn't that much movement. So that's why there's sort of that disconnect taking place there. Nevertheless, again, the Dow or the VIX lost almost 8 percentage points today, so that's also something to pay attention to as we move forward. Now, some of the other stories that I want to get to today have to deal with Alan Greenspan, the former chairman of the Federal Reserve. I say this facetiously, tongue-in-cheek here, but, I'm starting to love this guy a little bit to some extent because, a lot of these guys, once they're out of their positions of power, they get religion, if you will. And they could do no wrong. They could never see anything on the horizon that was about to smack them and the country in the face. But once they're out, they see things clearly. Now, this is true of Alan Greenspan more so than it is Uncle Ben Bernanke and Aunt Janet Yellen, because those two lunatics think everything's fine and rosy. At least that's what they say. Now, if they believe that, they're idiots. If they know otherwise, then they're lying to us, so pick your poison. Which one do you want? But at least Alan Greenspan is coming out and saying a few things. So he was part of an interview today on CNBC, and I just want to read a couple quotes that he said during that interview today. So he says, "I think the real problem is over the long run, we've got this significant continued drain coming from entitlements, which are basically draining capital investment dollar for dollar." Well, we talk about that here all the time. We talk about the national debt being $22 trillion, the unfunded liabilities being over $100 trillion, and most of that is because of the entitlement spending. Now, Alan Greenspan was the chairman of the Federal Reserve for a very long time, I think almost 30 years. Spanned a few different presidencies. I mean, he was there for a long time. The markets couldn't decipher what he was saying at all, and I think he liked it that way. Now we have the Federal Reserve coming out trying to be more transparent than ever, and they don't know what they're talking about. So that's why you have these policy reversals. Yeah, we're going this way. Oops, nope. Everybody threw a hissy fit. We got to go the other way. So you had one extreme, and now you got the other. Either way, and the Fed. These guys should not be in existence. But nevertheless, sticking with this interview, he continues. He says, without any major change in entitlements are going to rise. Why? Because the population is aging. There's no way to reverse that. And the politics of it are awful, as you know, Greenspan added. Hello, wake up. Did you not see this coming? I mean, we've had this conversation many times on this podcast, and we will continue to have this conversation on this podcast because that's what this program is all about. End of discussion. We got to wake people up. You got all these other media stations out there that are brainwashing people to just keep going through life like nothing's wrong. Everything's fine. Daddy, mommy, government has everything under control. Just go about your lives. Pay attention to your idiot celebrity on Instagram. Everything's fine. Don't worry. Alan Greenspan in the Federal Reserve, when he was there, under his leadership or lack thereof, very easily could have nipped this in the bud. He could have. Because 30 years ago, you didn't have nearly as many people who are retired right now. We didn't have $22 trillion in debt 30 years ago. He could have seen this coming. This ain't rocket science. People get older. Technology, science, medicine gets better. People live longer. This is not some sort of secret recipe here. Everybody knows this. This isn't a shocker. This isn't a surprise. So now, all of a sudden, it's a problem. And it's a big political problem. Obviously it is. People have been paying into these systems for 40 years of their lives. And now what's the solution? Well, you got to take it away to some degree. That ain't going to be easy because, at least when you look at the data when it comes to voting, older people tend to vote more than younger people. So there's no way that older people are going to go out and vote for somebody who comes up and says, we got to solve this problem. We have to limit your benefits. They're just not going to vote for it. They're just not going to do it. They're not going to bite the bullet. They are not going to take responsibility for this. Alan Greenspan had the ability to start a national conversation when he was the Federal Reserve Chairman. He could have put the brakes on it. You know how? He could have said to Congress, he said, look, this is going to be a disaster. You must change this because the Federal Reserve will not be accommodative. We will not lower interest rates to keep Uncle Sam's borrowing costs lower. So good luck finding a whole bunch of people out there who want to buy all of this debt that you're going to have to issue. So good luck. Good luck getting low interest rates without us printing money for you. He could have said it, but that's the game, folks. That's what I'm trying to tell you. The Federal Reserve and the government are joined at the hip. They are facilitators. of each other. We talk about this at length in our book, The Cynic's Guide to Investing. Buy it, check it out, study it, reread it. Okay? I'm telling you, it reads like a novel, but it's like a textbook at the same time. I am patting myself on the book because I'm proud of it. Because everything that we wrote in that book is coming true and has been coming true over the past few years. We published it in 2015, it's 2019. Everything has rung true. Everything. Check it out, I'm telling you. And this is no surprise, because this is all predictable. It isn't any secret sauce, secret recipe. All you have to do is look at the data and have a couple brain cells to rub together, and you'll see what's coming. That's all you got to do. Put away all of the noise, sit in a quiet room, and think and ponder about it, and you're going to come up with the truth. You're going to come up with objective analysis. Sometimes it's pretty. Sometimes you say, oh, we can buy something and it's going to go up and we can make some money. Other times you're going to say, I have to pull my money out of the market. Other times you're going to say, well, maybe if I'm comfortable selling short, I can sell this short and make some money on the downside too. But you have to become familiarized with these types of things, and that's what this podcast is all about. It's about education. It's about discussion of these items. So the Federal Reserve most definitely could come out and say, look, Congress, we ain't going to print any more money for you to buy up all your debt. So bigger and bigger chunk of all of the money that comes in is going to have to go out just to pay the interest on the debt that we're issuing. And that would be a wake-up call. But again, that's not what the Federal Reserve's here to do. They're here to put the pedal to the metal, print as much money as possible, and we've really been seeing that on overdrive, hyperdrive for the past decade. And right now there's no end in sight. And again, you got the lunatics from the White House, including the president on this one, coming out and saying the Federal Reserve needs to lower interest rates immediately by 50 basis points, and the president would seemingly be perfectly okay with quantitative easing number 4 taking place. In the midst of a economic miracle, mind you. Those are emergency measures, cutting interest rates. Well, cutting interest rates isn't necessarily an emergency measure, but quantitative easing is. But having both, that's a double whammy. That's definitely saying, okay, we're at DEFCON 3 here. I mean, we're about to push the button. I mean, this is emergency. This is go time. You can't have it both ways. You don't need an emergency measure if everything's A-okay. You don't need crutches if you're ready to run a marathon or the 100-meter. It just doesn't make sense. So which one is it? Are we going to win the gold, or do we need a wheelchair? I mean, what's taking place here? So you can't have it both ways. Does the president know what he's talking about? Is he trying to dance his way out of boxing himself in with taking ownership of this economy and the stock market? That's my objective. That's my opinion, rather. I think that seems to be the case. That's the logical conclusion I think one can draw when you look at how he has said that he wants to take ownership of this stock market and pat himself on the back. But again, he's only going to take credit and pat himself on the back when things appear to be good. When they go down, he's going to blame somebody else. According to this podcast, that's poor leadership, but that's what this president is going to do. Now again, on many things I defend the president, and on many issues I criticize him. That's what you get here. You get the truth as far as I see it. So you might like the fact that I criticize him. You might despise the fact that I criticize him. I don't care. That's what you're going to get. So that's Alan Greenspan out there, just, again, talking about demographics that you cannot stop, which we've said here many times before. If you're 60 years old, you can't go back to being 40. I know many people might like for that to happen. Maybe one day it will, but it's highly unlikely. You might feel like you're 40 again, but actually being 40 again is a completely different story. Completely different story, and that's not going to happen. So he could have nipped it in the bud, but he didn't, and now younger generations have to pay for it. And even the generations who are going to get it, who have been voting for it, are going to get less. One way or the other, they're going to get less. Cost of living adjustments increasing faster than what their actual cost of living adjustments would be. So, I mean, you really look into the numbers. I'm telling you, you're really getting screwed. You got screwed because you paid into the system for 40 years, and then your cost of living adjustments, everybody knows inflation isn't 1 or 2%. So you're just really up the you-know-what creek without a paddle. Sorry to tell you, folks, but that's just the fact of the matter. Now, some other things I want to talk about real quick. Our buddy Larry Kudlow, he was out again and basically said, we're probably not going to see increasing interest rates in my lifetime. That's Larry Kudlow. That's laughable. Unless Larry Kudlow is planning on taking a bridge here shortly, I don't know. Hopefully that's not the case, because that's just laughable. I mean, maybe the Federal Reserve won't increase interest rates, but the market might have a mind of its own. And we talk about that from time to time here. Sure, the Federal Reserve might want a certain method, but maybe the market say, we're not playing this game anymore. We're tired of it. Diminishing marginal returns kick in. A whole bunch of other countries might be in economic distress, and so they're not going to come in as foreign buyers to the bonds, and you're just going to have a mess. You're just going to have a mess. And they're going to say, look, Uncle Sam, your demographics are a big problem, the thing that we just talked about. You're going to have to pay us more because things aren't looking good for you, and we need compensated if we're going to lend you money. I mean, 2%, 2.5% ain't going to cut it. 3% ain't going to cut it. We need 4. We need 5. We need 6, 7%. If that happened, we're toast. And I think that's another part of the argument that the White House is coming out and making, because I think they're starting to realize that too. And they're saying, look, if these interest rates go any higher, how much higher is higher? What are we going to do? So I think it's sort of two sides of that coin. The president and the White House are trying to dance themselves out of the box that the president put them in. And then I think there's also some reality to it in regards to, look, we have all this debt being issued. We put forward our 2020 budget, $4.75 trillion with trillion-dollar deficits as far as the eye can see. So there's no leadership. There's no serious conversation in regards to these major problems. So this is what we get. This is what we get. We get a whole bunch of politics. We have banks making record profits. Doesn't quite seem like draining the swamp, does it? Okay, so that's Larry Kudlow. He doesn't foresee higher interest rates in his lifetime. It's laughable. Even Alan Greenspan during that same interview was asked about that, and he had a chuckle. I mean, it is. It's getting laughable. It's all you can do is laugh. Now, real briefly here before I let you guys go and enjoy your weekend, we talked about yesterday sort of the shadow banking and what we focused on a little bit more. And this doesn't just pertain to shadow banking, but the leveraged loans. And how the leveraged loans is definitely something that needs to be on our market watch list for issues for 2019 and forward. Okay? Because this isn't going to go away anytime soon. But we had the Federal Reserve minutes come out. We had a brief discussion about that yesterday as well. But in regards to leveraged loans, let me just read to you a couple excerpts from the Federal Reserve's minutes in regards to leveraged loans, okay? Financing conditions for non-financial businesses continued to be accommodative overall. Gross issuance of both investment-grade and high-yield corporate bonds, junk bonds, was strong in January and February, recovering from the low levels observed late last year. Issuance in the institutional syndicated leveraged loan market also recovered in the first 2 months of the year, as new issuance in February was in line with average monthly new issuance in 2018, and spreads narrowed somewhat from their December levels. Narrowed spreads basically means you're in a better financing climate. If you have widening spreads, that typically means that you have some sort of liquidity issues and there might be some panic in the market. So that's something to be aware of. The credit quality of non-financial corporations continued to show signs of deterioration, although actual defaults remained low overall. Commercial and industrial lending showed continued strength in January and February. Small business credit market conditions were little changed, and credit conditions in municipal bond markets stayed accommodative on net. So, the credit quality of non-financial corporations continued to show signs of deterioration, although actual defaults remained low overall. Well, hey, if the defaults are low, it's because they're continuing to lever up, which isn't a good thing. So if you have continued deterioration, but at the same time you also have an upswing in leveraged loans, guess what's going on, folks? They're taking out more money to pay for more money. You get what this is? This is what a leveraged loan is. It's a loan on top of a loan. And now we got them taking loans on top of loans on top of loans, kicking the can further and further down the road. So if and when this economy deteriorates, boom. Okay? Again, this isn't a secret recipe. You don't need to be an economist. You don't need to be a rocket scientist to understand this stuff. It's just not going to be good. Secondly, in regards to the leveraged loans, we have the other excerpt here. In their discussion of financial developments, participants observed that a good deal of the tightening over the latter part of last year and financial conditions had since been reversed. Now, to me, in the financial markets, I guess you can say that. I guess in the stock market, you can make that statement. But typically, anytime there is a interest rate hike or decrease for that matter, it actually takes quite a while to make its way through the economy. 6 months to 18 months is basically the rule of thumb. So for them to say so quickly that everything is already reversed, that's kind of telling you something. It is kind of telling you something. Several participants expressed concern that the yield curve for Treasury securities was now quite flat and noted that historical evidence suggested that an inverted yield curve could portend economic weakness. Again, that's something we talk about here all the time. Several participants pointed to the increased debt issuance and higher leverage of non-financial corporations as a development that warranted continued monitoring. So here you have it, folks, in black and white, the minutes from the Federal Reserve's meeting last month, right here in black and white. They tell you what to look out for. The problem is most people aren't reading this stuff. You have to be crazy like me to actually get some type of, well, actually, I used to enjoy this. Now, to be honest with you, I really don't like reading this crap anymore, but I'm going to continue to do it because I'm somebody who likes to be in the know, and I need to help other people. That's what I have to do because I just know what's going on. They are telling you, be prepared. There was a financial stability report that came out late last year, right before the financial issue, the 20% drop-off. That was something they discussed in their paperwork. This is their paperwork. They tell you what to be on the lookout for. I'm not making this stuff up. This is going to blow up in everybody's face. No ifs, ands, or buts about it. And it ain't going to be pretty. The money goes somewhere. A decade plus ago, it was going to subprime borrowers. Now it's going to these corporations. And everything ain't as peachy and rosy as everybody wants it to be. So check this stuff out for yourself. Again, I ain't making it up. Everything I talk about here can be researched, and I hope you do your own research because I can only talk about so much of it during these 30-minute podcasts. So go out there and educate yourself and help other people. Or if not, turn them on to the Capital News. I'd greatly appreciate it. The channel is growing little by little, and I appreciate every one of you who are doing that, who tune in every day, if not to the economic podcast, then to the geopolitical podcast. I love you guys, and I appreciate it. So enjoy your weekend. I'll catch you back here next week. Please like, share, subscribe, get the word out, leave your comments. I'd love to hear from you. This is the Capital News. I am Alex Kreitis. Godspeed.